The following content is meant purely for educational and informational purposes and should not be relied upon as financial, investment, legal, tax, or any other professional advice. This is the Fundamentals Podcast, where we demystify crypto and help you navigate this ever-evolving internet-native economy. In this episode, we're joined by Carlos Domingo, founder and CEO of Securitize, a financial services platform that specializes in the tokenization of real-world assets. We dive into the world of asset tokenization, starting with Securitize's journey from its founding to its role today as a leader in the space. We break down our framework for asset tokenization and discuss how token issuers transform legacy assets into more dynamic, interoperable digital assets that unlock new value creation opportunities. Carlos then explains the benefits of tokenization for all involved stakeholders, using different products available on Securitize's platform as examples. We dive deep into BlackRock's BUIDL fund that recently broke $500 million in deposits, and Securitize's most recent addition to their product suite, Hamilton Lane's $5.6 billion secondary fund. We also explore Securitize's rigorous vetting process for adding new investment opportunities, how they make money, the differences between on-chain and off-chain ledgers and reporting requirements, the challenges that lie ahead, and what it will take for Securitize to 100x their business. Tune in for a great discussion on the fundamentals of Securitize and asset tokenization. So, Carlos, welcome to the Fundamentals Podcast. It's great to have you on.
Yes, thanks for inviting me. It's my pleasure.
Yeah, we've been big fans of everything you guys are working on it over at Securitize. It's revolutionary work. And as we're focusing on the fundamentals of crypto, we have referenced you guys in quite a few of our recent blog posts, articles, and also tweets. So it's great we can have this discussion today to dive into the details of everything that you are working on. And I think the easiest question to start off here would be just for any viewer that isn't yet that familiar with what you do over at Securitize. Could you briefly walk through what Securitize is and kind of the key milestones of your story from founding until today?
Sure. First, I've been following all your reports and tweets on the space, and I think it's great. And one of the reasons I'm being here, because I think I think very highly of the reporting that you guys do in the space. So it's great being here. In terms of what we do, I will say what we do today is what people refer to as tokenization of real world assets. We started in 2018 in the first kind of wave of tokenization. Tokenization itself basically means taking an asset that is an off-chain asset and try to represent it on a blockchain so you can interact with the crypto and blockchain ecosystem. What we do, for the most part, tokenization of real-world assets involves issuing securities. Most of the time, either you're tokenizing something that is already a security, let's say like a fund or a treasury or something like that, or involves the process of securitizing the asset to be able to provide fractional ownership to the asset. This is why the reason actually we call Securitize, because tokenization is kind of like securitization on steroids, because it gives you like a better platform for securitization. And then we started, as I mentioned, in 2018 in kind of like the first wave of tokenization as a pure technology provider. We got a little bit of traction initially, but the market didn't really happen at that time. I think crypto people went in a completely different direction, and the TradFi people were not ready to come into the space for a variety of reasons, but one of them was not having like regulatory clarity about how tokenization works, who are the entities that can actually issue securities, represent them on chain, sell them, trade them, redeem them, pay dividends, etc. So since 2019 until I would say 2021, 22, we spent a lot of time building the tech platform, but also getting the necessary licenses to operate as a regulated entity. So we kind of moved from being a technology provider to be a service provider, where we use our licenses to basically work with issuers of real world assets and bring them on chain. And that's what we've been doing the last few years.
Yeah, that's amazing. Thanks for that overview. And I mean, definitely the number one player in this space right now. I've solidified some really great partnerships and bringing some amazing assets on chain. So I'm excited to speak about that in a bit more detail today. Now, I'm going to quickly share my screen here as a preface to something that I want to talk about, because tokenization is a term that we hear a lot nowadays, also from the crypto native community, but more and more from, TradFi folks who have started to dabble into the space. And, tokenization, just for the sake of tokenization, we both know there's no point in that. But I feel a lot of times the discussion stays at just that very, surface level of, okay, let's tokenize things. So about 2 months back, we put together an article where we kind of tried to walk through what tokenization is and why it's really needed. And I wanted to just preface the session a bit. I'm going to go on a slight monologue here about our high-level framework for how we think about asset tokenization over a token terminal, which I think will set the stage nicely for the rest of this discussion, because I want to then hear your thoughts on how you would build on this.
Sure.
So we made a table that has a bunch of different assets, right? You have crypto, cash, securities, commodities, identity, and more. And then we added 5 columns for each, as these 5 are the ones that we feel are relevant for understanding the how and why behind asset tokenization. You have the original asset, the ledger of origin, token issuer, destination ledger, and then finally the tokenized asset. To use the cryptocurrency world, the first one here is an example. In column 1, we have Bitcoin as the original asset. And then we have the original ledger in column 2, which is the Bitcoin blockchain. And then when we get to the tokenization part of things, when we want a representation of an asset outside of its ledger of origin, we need a token issuer, of which an example in Bitcoin's case would be BitGo, who creates a representation of Bitcoin on a new destination ledger, which is Ethereum via a tokenized asset. So wrapped Bitcoin in their case. And
you pick a very controversial topic for
yeah, I was just about to say. Yeah, it is timely in a sense. We could speak about the whole wrap Bitcoin debate for a while now, but let's save that for some other time. But conceptually, why we feel that this framework is great is that no one's really inventing anything new here per se, right? Like asset tokenization is really just about taking an asset from its ledger of origin to a new destination ledger, right? And the reason for doing this in our view is that original assets tend to have limited use cases and distribution, and therefore also limited value creation opportunities, because the ledgers of origin for these assets tend to run on legacy tech or isolated environments or both. So then you have these token issuers, such as Securitize in our table as well here, that see this as an opportunity to capitalize on by expanding the reach of the original asset from the ledgers of origin to new destination ledgers. And why? Well, because these new destination ledgers tend to offer more digitized, performant, interoperable, and auditable environments for the original assets then, which then means that the tokenized assets unlock new use cases, distribution channels, scaling, and value creation opportunities for the original assets, and also for the token issuers, which is their incentive to do this in the first place. And of course, the end users massively benefit from this as well. So, Carlos, what I wanted to ask you is that after this slight monologue here, do you agree with this high-level framework? I assume that you familiarized yourself with this piece at some point. And is there anything that we're missing or that you'd specifically like to emphasize here when we speak about what tokenization really is?
I think this is a very good taxonomy, by the way, because it's true that when we talk about tokenization, we talk about one specific part of tokenization market, which are securities, as I mentioned. But there is other use cases of tokenization, which involves, as you mentioned, to put an asset, whatever it is, on a public distributed ledger, whatever that one is, to make them more, sometimes not necessarily more efficient. Like a wrap BTC is not more efficient than BTC, but it interacts with assets that sit on that ledger, right? And I think for our case of tokenization of securities, one important aspect, and we can talk about this specific breakdown of roles in a second, but one specific utility that, tokenizing a security on a publicly distributed ledger is that you also have tokenized cash. Securities interact with cash, right? Because you need to, or with dollars in this case in the US, because you need to buy them, you need to sell them, you need to settle a trade, etc. So one of the use cases that is actually very interesting is not the tokenization per se of being in a better ledger, but the fact that there's other assets on that ledger that you can interact with in a native way and without having to synchronize two ledgers, which is the problem that you have in traditional capital markets of synchronizing the ledger that tracks the securities versus the ledger that tracks, the cash or whatever it is you're interacting with. From a security perspective, I think this is a bit more nuanced than this, to be honest with you, because it depends a little bit on what do you mean by token issuer, and also what is the specific role that you play. Like in our case, we sometimes are the token issuer, sometimes we're not the token issuer, we're the tokenization platform, but we're the manager of the token, if you want, but not the issuer itself. So I think that's a nuanced thing I will say. So for instance, in the case of KKR, we have created a feeder fund that is managed by one of our entities called Securitize Capital. So when you're purchasing that token, you're purchasing from Securitize, right? It's not from KKR directly. So we're kind of sitting between. In the case of BlackRock, for instance, you're not buying anything from Securitize. You're buying through Securitize, but you're buying from the issuer, which is BlackRock. We basically provide the tech platform to do it. Now, in terms of the ledger of origin, I mean, the SEC does not manage any ledgers. The Fed does manage a ledger, right? Because the Fed knows how many dollars are out there and keep track of the dollars, right? The SEC is just a regulator. The ledger of origin of a security, it could be a variety of things, right? It could be, simply the issuer itself that manages their security in a spreadsheet, in Excel, or I don't know, maybe you guys in your company, you use cap table management software to manage the the shares of the company and the stock option plans, that's actually a ledger that you're using to track that. Or what happens in regulated and more regulated environments, everything is regulated, but in more regulated environments is that there's two kind of use cases. The private securities, which in many cases, a transfer agent is the regulated entity that actually manages that ledger. So we are a registered transfer agent with the SEC, and as such, we're not the target ledger, but we manage the securities on the target ledger. Typically, for a non-blockchain based security, a transfer agent will use very, very outdated technology, which is part of the problem, and completely, centralized, isolated ledgers where they manage their securities. In the case of public securities, it's a bit more complicated because you do have a transfer agent involved, but then there is another ledger, which is the Central Securities Depository in the US, the DTCC, that has another ledger that contains the actual securities that are publicly traded that sit across broker dealers. So the ledger of origin for securities could be very, very simple or could be very, very complicated depending on the type of security you use. And then moving into the next one, the token issuer, as I mentioned, there's kind of like two different cases, right? There's asset managers that issue their own securities. So they are the issuer. BlackRock is the case. The Franklin Templeton, Wisdom Tree, these asset managers, they issue their own securities. And then there's kind of like this intermediate role of the transfer agent tokenization platform that basically manages those securities on behalf of the issuer, right? So maybe sometimes you might need like a fourth column, or like a fifth column here in between the third and the fourth of this, tech provider / cap table management company, which is what essentially a transfer agent is. And the rest is actually pretty accurate. The other thing I will say is that you have to move to other examples here, real estate and art, that for the most part, they actually end up also being securities, right? Because, if you have Manhattan real estate, if you tokenize the real estate and you issue one token that represents a building, that's not a security. That's just like underlying ownership on the building, and the kind of like the regulatory recourse that you have over the ownership of that token representing that is not very clear. But for the most part, when people tokenize real estate, they are either providing fractional ownership to a building, or they are tokenizing a real estate fund, or they are tokenizing the income stream of a fund, etc. And that falls under the securities. It's not a separate category from a structural perspective. It's a separate asset. So within securities, you can tokenize funds, you can tokenize real estate, etc. With art, it's the same. Artory actually does a real estate fund. So what they're tokenizing is not art. What they're tokenizing are securities, because you're not purchasing a token that represents art. You're purchasing a token that represents a unit on a fund that purchases art, right? So indirectly, you get exposure to the underlying asset, but the tokenization itself is for the security, not for the underlying asset.
I really appreciate that added nuance and context here. That is almost exactly what I wanted to hear as well. This might prompt us to create a revised version of this and go even into the more specifics.
Happy to help, because it's very useful for people, by the way. So because there is a lot of confusion overall in the industry about what tokenization is. So I think providing this sort of, taxonomies is very useful. What maybe I will do is, within the case of securities, I will add another column on the left. What is that you're tokenizing, and then how you're tokenizing it, right? And it could be as a security, it could be as a, you could tokenize the property title of a building, and that's not a security. Or you can be tokenizing an art fund or fractional ownership on a paint, or you could be tokenizing one individual piece of art, like an NFT is just basically one piece of art. So it's not a security. So it's a bit more nuanced than just this.
Yeah, definitely. I mean, we can help each other out and build an industry standard framework for this to help educate and push stuff forward. That'd be great. And
100%.
like you said, when building these frameworks, you got to use a lot of analogies and kind of squeeze things into places they might not fit. For example, the SEC is not a ledger per se. And the way we've thought about it is that when you have Edgar, the database there would be something that you could see as the source of truth for reporting on certain securities.
For some, because private securities don't have any reporting obligations, right? So you go to Edgar and you actually don't see anything about the asset itself, right?
Yeah, and you're exactly right. And that's what makes all of this so tricky. But really appreciate those thoughts in that context there.
And by the way, a lot of securities, believe it or not, the ledger of origin is actually a piece of paper. You'll be shocked too, because we own two transfer agents, the one we set up ourselves, and then we bought a traditional one to get more expertise on transfer agency, which could become very, very complicated. I think people underestimate the complexity of that. And that also manages some traditional securities, which in some case, they are actually share certificates. So they do physically have a piece of paper that represents the ownership on the security, and that still exists in the US.
That sounds so wild, being like
I know.
living day to day in a
So wild that, we will be still using paper for anything, but it actually is still.
yeah, it's crazy. Yeah, there's a long way to go to revolutionize this. But okay. Moving on maybe to the core value proposition one level deeper in tokenization. Now, I think we have a pretty good overview of what it really is and how you can split it down by the different parties that are involved. If we take the high level stakeholders involved in tokenizing a fund like the KKR investment fund that is in this table right here, it'd be great if you can kind of really break down for us the value proposition for the fund itself, as in why would they want it to be represented on another ledger, to have it on chain, and then also what the benefit is for an end user of having that tokenized.
I think first, as you said at the very beginning, tokenizing for the sake of tokenizing and say, okay, I have this securitized cap and I'll give you a token that represents the cap. Doesn't make any sense. I mean, it's a better ledger anyway. If you're using share certificates, using something digital is always an improvement, but it doesn't really change much except, maybe using a better ledger for tracking things in a more efficient way. I think what it becomes interesting is when it unlocks a different use case of something that is hard to do in the way the asset is traditionally represented, right? So in the case of alternative assets in general, this is not maybe KKR, Hamilton Lane, we work with a variety of asset managers, but they all kind of like have the same problem, if you want, is that those assets tend to be not sitting on a very efficient ledger. They usually will work with legacy providers like the traditional transfer agents of the industry, etc. And then because of this lack of digitization, if you want, in how they manage the securities and how they manage the investors and their holdings and the potential dividends or payouts or redemptions, etc., then they have a hard time basically scaling down to individual investors and to smaller units of the fund. So this is the reason why many of these funds are institutional, where they require a certain minimum investment. So they reduce the number of investors, and why those assets, once you receive them, it's a very cumbersome process, a lot of paperwork involved. Transferring the securities after that becomes very problematic, etc. There's issues with reconciliation, etc. So if you have few, 20, 30, 100 institutional investors, that's fine. The institutional investors will have a team of people to deal with that inefficiency. The asset manager will have a team of people to deal with the inefficiency. But if you want to go and start reaching individual investors, let's say accredited investors, which in the US is 15 or 16 million people, then suddenly not having this digital ledger that allows you to basically sell, issue, and track securities in a very efficient way across not tens or hundreds, but thousands of people, then it becomes a big problem, right? So I think they see tokenization as a way to basically provide much more efficient fractional ownership to be able to then reach individual investors in a meaningful way, right? Which is something it doesn't exist. So I will say that's one of the reasons why they're looking at for tokenization. The other one, it's actually a bit different. So, and maybe this is more related to what we do with BlackRock as opposed to what we do with, let's say, KKR or Hamilton Lane, which is the opposite. You're saying, okay, I have this asset that sits on a TradFi environment, right? Let's say like a money market fund, where if you're a TradFi investor, you go to JP Morgan, you open an account, and then you get your asset, your money market fund, and money market funds are very accessible. They're pretty much everywhere. So if you're a TradFi investor, there's no problem actually accessing the asset. Now, if you're a crypto investor and you want to live in crypto and you don't have a bank account and you only have stable coins and you want to have your assets on chain and you want to be able to use them on chain, redeem them on chain, and you need 24/7 liquidity and you need use them as collateral or on chain or something like that, the fact that the money market fund is accessible in the TradFi ledger doesn't actually solve your problem. So the problem there is not accessibility, but it's interaction with the crypto ecosystem by issuing native crypto assets that represent the traditional security. So BUIDL is an example of that, where the fund is fully on chain. It's in the public Ethereum blockchain for the time being. It's the issuance is as a token. The dividends are paid as more tokens on a regular basis after they accrue interest. There's peer-to-peer transferability on chain. There is redemptions against USDC 24/7, etc. So that is a kind of, if you want a different use case of not trying to reach different TradFi users, but trying to reach the crypto people that actually don't have necessarily a good access to a TradFi asset that they can use in their own ecosystem.
Yep, makes complete sense. So not just accessibility, but also like interoperability and fusing together these.
Correct. As I mentioned, one of the great advantages of tokenization, and then your taxonomy actually represents this well, is you're tokenizing cash and you're tokenizing securities, right? So the fact that securities interact with cash in a very efficient way, it's a great use case for tokenization, which you don't have on capital markets. Capital markets ledgers are completely disjointed. So if you want to buy something from JP Morgan, they'll sell you perfect wire me money. Then you have to wire money. So you have to go to one ledger to update it. Then that ledger gets updated. Then they have to update their ledger. Like this naturally leads to inefficiency, right? Because also you need to make sure those two ledgers are public markets where trading is very frequent. It's even more messy, right? Because you then things don't settle or instantly. You have counterparty risk between you pay for security at a price, but then you don't get the security until a day or two after, and then the price might have changed, etc. So in the case of BUIDL, for instance, the fact that you can interact directly with USDC is super valuable, right? Because it actually proves the point of having these two assets tokenized on the same ledger, make them very efficient to interact with each other. So.
That makes a lot of sense. Thank you for that overview as well. And if we look at the data, you guys definitely are not tokenizing for the sake of tokenization.
We try not to. We did some in the beginning that didn't make a lot of sense, but just to be fair with everybody, I'm very proud of what we're doing today, but I'm not necessarily proud of some early projects. But look, I mean, at the beginning, people were exploring the industry and trying to figure out how this works. And we've always believed that tokenization needs to add value, but in some cases, sometimes it does not, right? So I think the industry has matured, if you want, from that perspective.
Yeah. Yeah, and of course, I mean, you founded in 2017. You've gone a startup growth path, a pretty impressive one today, but you got to learn along the journey.
In November, we're 7 years old. So,
yeah, a lot of learnings from that journey for sure. My understanding right now is that only about 3% of potential investment opportunities pass your due diligence process on what you take onto your platform today. I'd be interested in hearing what that process really looks like. So, how you define what is worth bringing on to Securitize.
That's a very good point. I don't know if it's 3%. I don't know who told you that, but it's a very low number because we get a lot of projects that we're not interested in doing. And I will say maybe in the past, we might have taken some of them. I think at this point, we're trying to focus on very high quality, high-end asset managers. I think that, tokenization, like it happened to crowdfunding at the beginning when it started, it suffered over the years a little bit of the, the adverse selection problem, right? So there is people that have, not really good quality assets. I was going to say shitty assets, but it's probably not the right word for a public interview. But let's say bad quality assets that they don't know what to do with it. And then they hear about tokenization and they think, oh my God, this is like a magic way to dump this bad asset into the crypto people because the crypto people have flush with money and they will just buy whatever if it's in token form. And of course, the crypto people are not stupid. I mean, the crypto people buy tokens when they see there is an opportunity to make money. So if you tokenize a bad asset, it doesn't actually, nobody wants to hold the asset just because it's tokenized per se, right? So we get a lot of these projects, a lot of these, esoteric projects that I'm going to tokenize this, whatever. Like I've recently got an email, which was very interesting because somebody wanted to tokenize the debt of a country, which is a very small country. I'm thinking that was a great idea for this country that cannot sell their own debt because nobody believes that the country is so solvent and that without way somebody's going to buy it. So you'll be shocked about the projects that come our way. So I think that we've passed this point. I think that, tokenizing for the sake of tokenizing is not a good idea. And on top of that, if the asset is a bad asset, tokenization is not going to turn it into a good asset. So we reject mainly low quality products or products where we don't think that tokenization necessarily adds any value and therefore it misses the point of why you're tokenizing. And then keep in mind that we have two businesses. We're a transfer agent, we're a broker dealer. As a transfer agent, we will have maybe take some projects that people want to do it and we think there is no risk, the issuer is legit, it passes our due diligence, it's fine. But as a broker dealer, we're facing the investor, right? So if an investor buys the asset, they are buying it from us. So we have to be extra careful to make sure we only provide quality assets because otherwise it degrades our brand, it degrades our the experience in our platform or buying something that is not good, etc. So as I mentioned, I think crowdfunding companies probably are a good analogy that they probably have the same similar challenges with, bad startups that they cannot raise money and then they think, if I do a crowdfunding, maybe retail people that don't understand anything will buy my securities shares in my company, and that's a huge risk for those platforms. The same way that for us is a risk to put bad products in our platform.
Exactly. I mean, if the asset is subpar quality on the ledger of origin, then you're just kind of expanding that, and it's going to be subpar on a new destination ledger as well. So.
Like if you have a really bad, risky real estate project, just to pick an example of a popular one, then that you can't actually raise any money in the traditional way. and then you think tokenization is going to help you raise money because crypto people are less sophisticated. That's actually not true. That's actually totally not true. First, also, crypto people are a different profile of investors. They maybe look for different type of assets or risk profile. But in any case, they're certainly not stupid. They're very savvy people, and a bad asset on chain doesn't make it a good asset.
Yeah, exactly. Now, I want to speak a little bit about your business model and how you kind of generate revenue. But I think a good place to start there is understanding the fact that you have two businesses that you mentioned. And I think most people probably not in the crypto space have come across Securitize through BlackRock's BUIDL fund. So maybe if we speak about that for a moment here, it would be great if you could walk through how BUIDL as a fund is structured and what specific role Securitize plays in that structure, both now and potentially as the fund evolves.
So BUIDL is a private fund that contains short-dated treasuries, which is managed by an asset manager called BlackRock. So it's their fund. It's incorporated in BVI. It's for qualified purchasers only, 5 million minimum. So it's geared towards institutions, and it's managed by BlackRock, right? So when you're investing in BUIDL, you're basically giving the money to BlackRock for BlackRock to deploy it in short-dated treasuries that generate something close to the Fed rate. So Fed rate minus the fees that the asset manager take, and that they use kind of like traditional providers behind the scenes to manage that fund, right? Like BNY Mellon or companies like that. What we do is when you purchase a unit of a fund, whether it's from BlackRock or from anybody else, they have to issue securities, right? Because that's the proof of ownership into the underlying fund is the security, the unit of the fund that you've purchased, right? So traditionally, this role of issuing the security is played by a transfer agent. So let's say BNY Mellon is a good example of a traditional transfer agent. So, but of course, as we discussed, these guys use outdated ledgers and do not interact with the ecosystem. So we kind of played that role to start with. We're the transfer agent of the BUIDL fund. And as such, we actually issue the securities on the blockchain. And we use our technology infrastructure and a tokenization platform to be able to do this issuance of the securities on chain. We create the smart contracts. We control the transfers with rules on the smart contracts, update the ledger every time there is a change. We pay the dividends by issuing more tokens on chain, etc. So that's our role as a transfer agent. Then we also act as the placement agent for the fund. So if you want to purchase the fund, you come to Securitize, and we use a different entity called Securitize Markets that basically will onboard the investor. So obviously this token is a security, so we need to know who is purchasing and that it meets the requirements of the buyer. So we will do the KYB in this case, the know your business. These are entities, not individual investors. And once we've onboarded the entity, they have an account with us in Securitize, and then they can actually purchase the fund. And then the transfer agent will basically, issue the tokens to them.
Yeah. Okay. Thanks for that breakdown. So my understanding is that the investments and redemptions are done in USD to and from Securitize's bank accounts for the BUIDL fund, right? And then you just mirror these off-chain transactions or the cap table on-chain yourselves. Is that correct?
No. So the investment, so we don't touch the money. When you invest on the BUIDL fund, you basically are wiring money to a bank account that BlackRock has for the fund. If you invest in dollars, in US dollars. And then at that point in time, we are integrated with the bank account. So we do monitor the bank account. And then when we see that money has hit the bank account, then we will issue the tokens that represent the securities. And then BlackRock will deploy the capital into the fund. And we do that on a daily, once a day at 2:30. So
Got it. There we go.
Instantly, we just monitor it. And then once a day, we issue new securities and BlackRock deploys the capital. When you redeem, it's the same process, right? You send to Securitize your instructions of redemption. So we have a redemption wallet where you send tokens, and then we detect that the tokens from investor A have arrived to the redemption wallet. At that point, then we freeze them. So make sure that they're not being redeemed twice, or they're not being redeemed and sold or something like that. That's why the token actually works very well, right? Because if the token leaves your wallet and it goes somewhere else, you don't have tokens anymore. You can't do anything with them. And so there's no potential of like double counting or anything like that. And then at that point in time, we instruct BlackRock to liquidate the position. And then from their bank account, they will wire the money back to the investor. That's the USD flow, right? If you have USDC, so USDC for investment, it's something we still don't have, but it will come very soon where you will be able to just basically deposit USDC. Our platform does support USDC, but not for the BlackRock fund. And then for redemptions, it's really not a redemption, but it's basically we have an agreement with Circle where Circle buys, the BUIDL tokens using USDC that they provision in a contract as a swap. So you can sell BUIDL tokens to this contract governed by Circle, and Circle will send you USDC, will keep the BUIDL tokens for themselves.
Yeah, so with fiat, it's a BlackRock owned and controlled bank account that you then essentially mirror on chain
Correct.
with your
So
transactions.
the fund, the bank account belongs to the fund. That's usually the process. In the Securitize platform, we do have cash accounts, we call them. So if you create a Securitize ID with us as part of the onboarding process into our platform, we will give you the option to create a cash account. And then if you want to invest in the funds that are managed by Securitize, BUIDL is managed by BlackRock, so it's a bit separated, you'll be able to deposit money into that cash account through USDC or through ACH, Wire, etc., and being able to do the investment from there, which the investment is instant, right? Because the money is already in our platform. So,
okay, yeah, thanks for that breakdown of the BUIDL. I think that's really interesting for a lot of people who are following the traction. I think we're at $517 million in asset under management around there. So that's a pretty massive thing to have brought that on chain. Now, in terms of business model, this is like a very interesting question that we've spoke about internally. Is that in this, what is like the business opportunity? How does Securitize make money, both in the case of BUIDL and then also for the funds that you manage?
So we make money in a variety of ways. So as a transfer agent, we're a provider for the asset manager. So in that case, the asset manager pays us a fee for providing a service, the same way that they will have to pay to, I don't know, State Street or BNY Mellon in the traditional world, but we happen to be on chain. As a broker dealer, we also take placement fees because we are responsible for selling the fund. So any asset manager will, distribute their products through warehouses or broker dealers and pay a fee for that distribution because that's how they gather investors. So those are the models. In the case when we manage, let's say, a feeder fund, we then charge a small fee to the investor because we don't charge that to the asset manager because the asset is with us. So there will be the feeder funds. Usually that's very common in the industry because all the wirehouses like Morgan Stanley or Goldman Sachs, JP Morgan, they do the same. Which when you're buying from them, you're not buying directly from the asset manager. You're buying through a feeder fund that they manage where they put a little bit of fee overlays, like a few basis points on top of it. So we make an AUM fee, if you want, on top of the broker dealer fee for distribution. In that case, transfer agency is something we do for ourselves internally, so we don't actually make money.
Thank you for sharing that. Now, one more question on like your product suite, because this is like a really recent announcement. I just read yesterday, you announced that Hamilton Lane's $5.6 billion secondary fund is exclusively available on the Securitize platform. So could you maybe speak about the significance of this and what that means?
Well, this is one of the largest secondaries fund that Hamilton Lane has ever done. It's been extremely successful. Then we have a slice of it that has been, tokenized and offered exclusively through the Securitize platform. So if you want to get access to that fund, which, secondaries are very interesting for a particular reason. Like when you invest directly on a single fund, you typically have two problems. One is the longevity of the investment. Like typically funds last for 7 years or something like that, and for the most part they are illiquid. So you need to be willing to like hold the asset for a very long time until you get returns, because typically fund asset managers will receive the money, they'll start investing, and then as the investments mature, but usually this takes years, then the companies exit and then money gets returned to investors. So you have a liquidity issue. And the second issue you have is a selection issue, right? Because if you invest on one fund, that's it. So either that fund performs well or performs bad, but you only have assets in one place, right? So a secondaries fund like the one from Hamilton Lane is very interesting for two reasons. One is first, because it's a diversified investment. They are buying positions in many funds. So you kind of like getting less risk because of the diversification of the underlying. And then they are the ones picking the funds, right? And they're professional investors, obviously, so they probably will do a better job than you and I. So I don't know if you're an expert on this, but I'm certainly not. So, and then the second thing is because they're secondaries, it means that they buy these positions in the middle of the life cycle of the fund, right? So it means the liquidity will come a lot faster than if you were investing in the fund. So typically funds have what's called a J curve, where at the beginning they go down in value before they go up, because at the beginning they're deploying capital and they're charging fees, but the underlying investments have not increased in value. And then at some point in time, the underlying investments start like increasing in value. The capital has been already all deployed and the value of the fund goes up. So typically they will come and try to buy it somewhere in the mid-cycle. So early stage investors on the fund have an opportunity to exit at a particular return, and new investors buy in the fund when it's already more seasoned and therefore has the risk a little bit, the execution. Of course, you also have less returns, but it's a safer, if you want, more conservative investment approach than and a shorter liquidity duration than buying an individual fund at the very beginning.
Okay. Yeah. That is really exciting stuff. And I mean, congrats on getting that onto your platform. Feels like you guys are on a roll right now. So it's great to follow.
We are on a 7-year overnight success.
Exactly how it goes. Now, one thesis of what could be like some massive unlocks for more institutional interest towards like crypto, the asset class, and especially in terms of this discussion, like tokenized assets, could be that these large fintechs like, Coinbase or Robinhood, where I feel Vlad from Robinhood has now been going along like a media tour speaking about how they're going to go head first into crypto. I feel like a huge thing that they could do would be to tokenize stocks, or then for someone like Coinbase to expand into the equity space outside of just crypto and tokenized stocks and just build an all-in-one financial platform. And my question to you is, as these companies like Robinhood begin to recognize the operational efficiencies of blockchain tech and explore tokenizing assets, what role could like Securitize be playing in supporting these traditional financial platforms with your infrastructure and expertise?
So I listened to the Bankless interview that Vlad Tenev did. I thought it was great. I've been talking on and off to the Robinhood team over the years, and I think that getting Robinhood to enter the space will be great. I think that will be a really really good thing because these guys have something that nobody else has, which is they have the TradFi infrastructure, which at the end of the day is required to some extent for tokenized assets because, as we mentioned, they're all securities, and these guys operate a very large broker dealer in the US. They have an audience, but they also have the crypto know-how audience and as well as desire to get deeper into the crypto ecosystem. So I thought that interview was very interesting from how he explained how the crypto platform is more efficient than the TradFi one. And I think tokenized assets could be a way to bring those TradFi assets into their crypto platform in an efficient way, right? In terms of what role we play, I mean, I think that we are kind of like the bridge between the asset managers and the crypto people, right? But and Robinhood has distribution. We have the infrastructure to be able to tokenize in a regulated and efficient way, and the experience and the expertise. So I don't see that as a competing. Of course, we do distribution ourselves now, but that's not where our strength is compared to say Robinhood, right? Robinhood has, I don't know, 40 million people on their platform. So I think that these large platforms that have an audience, like Robinhood or Coinbase, I think Coinbase is a bit different because it's less TradFi, a lot less like zero, and more crypto. But I don't know if they have a desire because they've been sitting on a broker dealer for a period of time and they've never released anything or done anything with it. So, but somebody like Robinhood, which sits at the intersection of crypto and TradFi, is a potentially a very exciting participant into the ecosystem that we'll definitely love to see.
Yeah, that's something that remains to be seen. And I mean, there's a lot of question marks in the air to see how these companies will adopt crypto and how guys, for example, will be able to capitalize on that. So thanks for sharing those thoughts.
I think, look, I mean, if you think about it, this idea of the one-stop shop where you get all your assets in a very good, efficient UI and a good, efficient, settlement process and having control over the assets, potentially more functionality over those assets, etc., is probably something that somebody will figure out, right? And when you figure that out, you need to have multiple asset classes, right? You need to have public stocks, and then within public stocks, there's all sort of like different derivatives of them, like options and stuff like that. Then you need to have crypto. And again, within crypto, you can just buy spot Bitcoin, or you can buy now ETFs, or you can buy derivatives in crypto, etc. But then there's this whole other, massive asset class, which are alternative investments, funds, etc., that today are the most difficult to access asset class. But if you look at how institutional investors split their money, they'll put a portion of it, a significant one, 20, 30%, on alternative assets, right? And that's tens of trillions of dollars market size. It's just simply that it's not accessible to the people because you don't have a Robinhood that allows you to buy, a mutual fund in an efficient way, or allows you to fund a hedge fund, or allows you to buy a money market fund, etc. So I think tokenization can basically add this asset class there, providing also more efficiency and more functionality for the underlying asset. And then there's another interesting things with tokenization, right? You could think of, I have a US asset, let's say a US stock. If I could legally tokenize it to make it accessible to non-US people through some sort of derivative, on-chain, etc. I say legally because this has been tried in the past in not necessarily a legal way. And the SEC and the CFTC have been shutting down some of these things. But I believe that somebody like Robinhood or us could figure out how to do it on a legal way, and then you're basically overlaying tokenization on top of other asset classes that are accessible in some places but not in other places, right? And that's another advantage.
That's fascinating. Now, I want to move on to ask a very kind of token terminal related or specific question here in terms of on-chain data, because you're kind of at the crossroads of TradFi. We have these ledgers that are pieces of paper, and now you all of a sudden have transaction logs and records on public blockchains. So I want to kind of understand how you're leveraging on-chain data, how you see that space moving forwards, and especially from the perspective of reporting requirements. Like what do those look like today for an on-chain money market fund? And how do existing reporting requirements work with transactions being on chain?
So first, what kind of reporting requirements you have, it really depends on the underlying asset. In some cases, if it's a private fund, you don't have to report anything of the activity. But one thing I've always told regulators is that precisely on private markets, they have zero visibility about what happens. Like you just need to rely on the issuer. Like people file this form with the SEC that are in Edgar that says, I've raised $10 million from 10 investors. There's no way to verify whether that's true or not. You have to rely on people self-reporting those things in an accurate way, right? So I think on-chain should be a way to provide more transparency to markets and to make regulators feel more comfortable about what's happening, right? Because there's nowhere where you can hide, and also it's an immutable ledger, right? So you could things moving forward, but whatever has happened in the past stays there, and people can actually see it if it was a transaction that was wrong or something that happened, or what's been the evolution of the security, etc. So I think that, and then ultimately, from a reporting perspective, for the cases where you need to report, I think having a very accurate ledger, it's very important, right? Because believe it or not, a lot of the asset managers have reconciliation errors. They need to send dividends and they send them to the wrong people, or they don't know exactly the holders, or somebody has changed and they haven't updated the record somewhere. And the fact that you have a ledger that is accurate 100%, that you can use to conduct corporate actions like dividend payouts or voting if you wanted to, etc., it's super important. And I think that will basically provide a lot of improvements for how capital markets are being managed and how transparent they become, and how much more, if you want, compliant with the law, right? Because it forces you to be compliant with the law, because otherwise it's going to be visible there.
I agree with you completely. Now, at what point do you envision then that blockchain-based records become the primary source of truth, with the on-chain data being the official one that the SEC recognizes? Because right now we're pretty far from that. So
I'm not sure we're far from that. This is a very controversial topic in the industry, because some people like to claim, oh, my fund is recorded on the blockchain and I'm the only one that I use the blockchain as the source of truth. And then people say, oh no, but you have offchain data that's not on the blockchain, therefore you're not blockchain native. So first, I run a transfer agent, right? Mm-hmm. Which is the one that actually records the ownership of the securities on a ledger. There is no regulation I know that tells me which ledger I need to use. Just, it doesn't exist. As a transfer agent, there is no regulation at all that tells you, oh, you need to use Excel spreadsheets, or you need to use a piece of paper, or you need to use an Oracle database, or you need to use a public blockchain. So that doesn't exist. So I think it's more about, regulators making sure you're using the ledger in a proper way, and those ledgers are reliable, and then they're going to disappear, then they're going to fall apart, then they're going to have a 51% but there's nothing that prevents you to use a public blockchain, as far as I know, for recording. And keep in mind, regulators, in particular here in the US, the chair of the SEC likes to say that crypto shouldn't be regulated differently just because there is a different underlying technology. And I actually welcome that comment. I shouldn't be regulated differently because I use a public blockchain as the ledger for my regulated entities. I should be able to do the same thing that any other broker, dealer, or transfer agent do. I just happen to do it in a better way with a much better ledger that is, cryptographically secure, it's public, it contains cash on chain, it's transparent, etc. So I think the blockchain is also not necessarily a good ledger as it is today. These things obviously will evolve to keep all the entire data that you need to keep on the ledger, right? Because one of the things that you don't want to keep on chain is the personal identifiable information of the investor, because otherwise people will know on chain who holds the assets, and not everybody wants that transparency, investors in particular. So typically on chain, what you see is a pseudo-anonymous chain where you have wallet addresses, but you don't really know who they are. In some cases, people actually do know Like in the BUIDL, some of the assets are tagged by Etherscan and we know to whom they belong, but some others are not. That's up to the wallet holder. But we have to keep an off-chain record of who the person is, right? Because we have to do investor onboarding and KYC, KYB for each investor, etc. And obviously that data doesn't go off-chain, on-chain, right? On-chain goes basically the link between this investor to this wallet, to this amount of assets. And that's how we operate. So, but we use the blockchain as a ledger. Like when something changes on the blockchain, that's when the ledger gets updated. And if it doesn't change on the blockchain, the ledger doesn't get updated.
And that is, I have to admit, I actually wasn't aware that there is currently no regulation that says that you cannot use a public blockchain as the destination ledger.
There's no regulation for any type of ledger, by the way, not just blockchain.
Same time, again, a bit scary.
Because regulation is technology agnostic, which is what Gensler always says. And he's right.
Yeah. I mean, I'll take that as bullish for tokenizing assets.
I think that what regulators are doing is they are understanding that this ledger technology allows you to do things in a different way. And they are kind of trying to put rules around what happened when you use this ledger technology, right? There is this, for instance, in the US, there's a special purpose broker-dealer, which talks about custody on a blockchain. And they have a number of things like saying, okay, what happens if there is a 51% attack or if a fork, et cetera, because that impacts the ledger, right? But, by the way, you could have your assets on AWS and there's a hack and you also lose the ledger, right? Because it sits there or the data center falls apart and the bank doesn't have access to the records. So those things can happen with other ledgers as well. It's not unique to a blockchain, right?
Yeah. And I mean, we're betting on that. We're building our business around the fact that, the source of truth for all transactions in the world will be on blockchains and building standardizations around.
It will take a very long time for that to be true because I think that, look, what's going to happen, in my view, is that there is a famous book called Crossing the Chasm that talks about the curve of adoption things. And then, the beginning is when the curve is very small, is if you want the early adopters and the technology, enthusiasts, the innovators that adopt the technology. I think that's where we are with crypto. The majority of the assets are like really, really far out. And then there's another problem, which is, those assets today, they have very inefficient ledgers, but they have figured out how to make them efficient with lots of building blocks and infrastructure on top of it. So there's kind of two scenarios. One is you go and replace all that legacy infrastructure, which I think will be very, very difficult. Like the other one is there is a new kind of like financial market that appears that is natively on chain that also has traditional assets that are being issued natively on chain, like let's say what we do with BlackRock, and that grows to become big enough that eventually the legacy infrastructure is turned off, right? If you think about I used to work at telecommunications industry, and then we had the copper networks for fixed line, right? And then fiber came. And fiber didn't replace the copper line. Both coexisted for a period of time, but the activity slowly moved to fiber, and people started like using, all the first ADSL on top of copper, then fiber, then mobile, blah, blah, blah. And eventually now they're shutting down the copper networks. But it has taken decades to do that. So I think that's a good analogy. Like we're building, the fiber networks and the mobile infrastructure, and the copper network are, the TradFi companies, and they will continue being there for a period of time, and you will never kind of like replace them, but they will die eventually because nobody will use that, like it happens today with fixed line, right? I don't have a phone at home. I haven't had a phone for, 10 years. Yeah. I just have a mobile phone and that's it, right? So whoever built the copper network reaching to my condo, that's completely, they can turn it off and nothing will happen.
Yeah, exactly. That's innovation. Now, just final question here to wrap this up. This has been a really great discussion. What is the one biggest practical hurdle that is necessary to overcome for Securitize to 100x your business? And how are you addressing that challenge?
I think that one of the things I'm most excited about is because we discussed at the very beginning, and this is like a good segue to close the discussion, token utility is very important, right? Because the tokenized asset needs to be a better asset than the non-tokenized asset. And that means you can do certain things. So we do have some examples of that. Peer-to-peer transfers are better than traditional transfers. On-chain redemptions or subscriptions are a better way to do it, etc. But there is a whole, part of the crypto ecosystem that has very innovative platforms, which is DeFi, where the real world assets today don't really interact well because of the nature of DeFi being permissionless, anonymous, etc. I think that when we figure out how to bridge this gap between real world assets and DeFi, we will then bring more utility to the token. You have a more efficient lending platforms. You will have more efficient liquidity through automated market makers, etc. So that's the part that I'm more excited about it, and that's the one that will actually make the tokenized space to grow much faster, because then a lot more assets will move on chain because suddenly they will be way better, right? So
Yeah. Looking forward to see that bottleneck be removed and
Hopefully
you
soon.
guys, unlock that 100x growth. Hey, thank you so much, Carlos. Really appreciate your time today. This is some
Yeah, thank
super
you guys for
insightful
the invite.
stuff.
It was my pleasure.
Of course, definitely to continue offline, build some more taxonomies and frameworks to help
Let's
people
work on
better
that.
understand what's going on.
Thank
Thanks
you.
so much.